Hello and good evening to this special show, Earnings Review with ET Now with me, Aisha Faridi. And it's been a tough quarter gone by, hasn't it? The macro backdrop has been the worst in recent times, with INR depreciating 5%, hitting an all-time low of 69.1 to the dollar, Brent crude rallying 15%, 10-year bond yield increasing a meaningful 50 basis points. And there's been a moderation in the macroeconomic indicators as well, with both CPI as well as WPI moving higher. Industrial production as well disappointed. And then there are concerns about trade deficit, which also is already deteriorating. To add to that, the broader market valuations also have derated higher than market correction of 3.5% from the January peak. Although D-Street experts believe that the remainder of the year will be marred with high volatility and moderate return for equities. With this context, all eyes are now on earnings to provide the glimmer of hope. So will we or won't we finally see earnings normalize? Let me welcome my two special guests on the show, Ravi Sundar Muthukrishnan, Head Institutional Equity Research at Elara Securities, and Gautam Duggad, Head of Research at Motilal Oswal Securities. And Ravi, if I could come to you first, really the kind of macro backdrop that we have seen of late and broader market outperformance, the macro concerns with rupee, crude, 10-year paper, IIP, inflation, trade deficit, what have you. How critical is it that we see an earnings recovery, since it only seems that that's going to provide that glimmer of hope and a leg up for the markets?
Yeah, to start with, I think this quarter the operating profit growth will be about 14%, roughly about that range. Whereas the PAT growth would be about 10% for Nifty stocks. The reason why the difference comes is because of the huge interest expense of Ultratech. But as you rightly said, there is going to be quite a lot of headwinds now. For instance, despite the lower base of last year because of DMON and GST, the numbers for the Q1 FY19 is not so encouraging. At the rate at which it's going, and if you consider the FY19 estimates which all of us have factored in, the earnings for the next 3 quarters has to grow at about 27% to be able to justify the FY19 numbers. So in the consequence of all the headwinds you rightly talked about just a couple of minutes ago, my sense is that there could be a lot of downgrades, because in the next 3 quarters the earnings have to grow at about 27% to be able to justify the FY19 number, which is roughly about 538, something like that. So yes, the pain is there. The pain is going to be more pronounced. As a consequence, you could expect more downgrades moving forward.
Okay, that's the expectation coming in on an overall macro basis as to what to expect from earnings. Gautam, if I could get you in, and banks really, considering we're going to kickstart earnings with IndusInd Bank, do you believe that concentration of the earnings is going to be yet again with the cream, top tier private banks, or do you think there's higher beta to play when it comes to PSBs or perhaps some of the beleaguered corporate banks as well, which have been suffering in the past?
Hi Aisha, good afternoon. So as far as banks is concerned, I think for this quarter at least the entire game is with the retail financials and of course the NBFC. The NBFC pack continues to remain very strong. We are expecting around 38% growth for the stocks that we cover in NBFC. For private banks, our universe is expected to post a 9% growth, but that's largely because of the drag from ICICI and Axis. The retail private banks, there we're expecting around 23-24% kind of a growth. So the likes of Kotak, Indus, Yes, HDFC Bank, RBL, I think all of them are going to continue to post a very strong trend growth rate. And you have to keep in mind that the value migration from PSU to private banks, which has been happening for last many years, has actually accelerated in the last couple of quarters, more so after the host of public sector banks started getting into PCA. So the field is quite open for the private banks to gain market share, and that's what they are doing. And I think just to extend that argument, in fact, this year's earnings from the second half, actually second half of FY19, will rest very strongly on the shoulders of this private corporate banks as well as the PSU bank. So if I were to just mention our Nifty numbers, we are expecting 1/3 of the incremental growth for this year in FY19 to come from this set of 3 banks, which is SBI, ICICI and Axis. In fact, we are expecting 26% growth in Nifty profits. And if I remove those three banks, that growth just stands reduced to 18%. So large part of the earnings normalization that we are expecting in FY19 is to be driven by the private corporate banks and SBI. But that should be a second half of FY19 story. In the first half, it will still be largely driven by private banks and NBFC.
Ravi, what is your expectation from both PSUs as well as private banks? Do you think the migration from PSU to private banks is going to continue? Or do you think after a muted FY18, PSU banks could expect a gradual pickup and thereby perhaps there's higher beta to play if you stick by with those names?
Yeah, again, if you look at the private bank space, we are more positive about the retail lending banks because of the fact that the growth has actually come in from there. And moving forward, I still expect the growth to come from there as well. The corporate lenders still have a pain. The credit growth is not so visible. PSUs will continue to have their own problems. So as a consequence, I would not recommend investors to switch from private banks to PSUs as of now. I would rather want to wait and watch because the NPA issues are still looming large, and then this being an election year, I don't think there could be too much of infusion of capital into these PSU banks. So as of now, it's more of a wait and watch for me for PSU banks.
Fair point. You know, in fact, we're going to pause for a second and take it across to our research desk as well. They've been collaborating data on what to expect from the earnings. So I'm going to take it across to Poonam first to tell us exactly what is the street expecting from financials, and then I'm going to come to Pranay. But Poonam, you go first.
Well, in terms of the financials, especially in terms of the retail-focused banks, we should be seeing the profit growth of anywhere over 20% ought to continue. And within this, of course, IndusInd Bank and HDFC Bank would be reporting strong profits, along with Yes Bank, which is also expected to report profits and profit growth anywhere between 20 to 25%. But corporate banks, which is including ICICI and Axis Bank, they should be still reporting some amount of pressure in terms of their overall financials. Having said that, the large PSU banks would still be reporting losses, but losses would moderate on a quarter-on-quarter basis. Similarly for ICICI as well as Axis Bank, hopefully we do see some profits this time, but the stress in terms of the overall asset quality would still continue during this quarter as well as the next quarter. So yes, the asset quality stress for the entire corporate banks is still likely to continue for the entire H1. Within the entire corporate banks, IndusInd, Yes Bank, HDFC Bank, Kotak Bank, they should be reporting good profits. Speaking about NBFCs again, overall growth is still likely to remain fairly strong, but again, Ind AS norms may impact or lead to some amount of volatility there in terms of the earnings. Having said that, Mahindra & Mahindra Finance and Shriram Transport Finance should still be able to deliver slightly better in terms of the overall asset quality, and Indiabulls Housing Finance may see some amount of volatility in terms of the earnings on account of the Ind AS norm. So yes, overall good quarter again for retail focused banks, and a mixed quarter coming there for some of the NBFCs.
Okay, we'll leave it at that, Poonam. And Pranay, to you then, we're going to kickstart our day tomorrow with the IT bellwether TCS reporting its numbers, largely from the sector. What is it that we can expect?
Q1 is traditionally a good growth quarter for the IT sector, and most tech stocks have hit record highs in this quarter gone by. But even though INR depreciation is something that comforts, there are going to be cross-currency headwinds as well as wage hike and visa costs, which will weigh on the margins this time. So if you look at growth, TCS is expected to lead the large cap pack over here. Comparatively, HCL Tech and Wipro will be tepid. Even if you look at Infosys, the stock also touched record highs, but it's going to be the second growth quarter under Salil Parekh. So the constant currency performance will be important to watch while there is confidence on their margin execution. Also, if you look at the mid caps, then it should be divergent. Hexaware, Mphasis, Mindtree are expected to post robust performance this time, but Cyient and NIIT Tech are expected to be tepid comparatively. So let's see whether we see all these expectations being met, because any disappointment will lead to brisk correction in a lot of these IT stocks.
Okay, Ravi, I want to get your thoughts in on IT because, like my researcher as well highlighted, the first quarter of the financial year is generally a good one for IT. We've seen a drastic outperformance play out in the entire IT sector and largely the large caps. The rupee depreciation we all know is a major tailwind for the entire sector. But would you say that perhaps earnings could be better when it comes to mid-cap IT, or do you think it's going to be the large caps and within large caps as well, TCS which is going to lead the pack when it comes to earnings delivery?
See, by and large, if you look at the IT sector, there are two things which I think would be definite tailwinds for the sector. One is the rupee depreciation itself, and the other one is the healthy environment you see in the US. So my sense is that the sector as a whole should post decently good PAT numbers. I think we have penciled in about 10% growth in PAT. I think the biggest beneficiary would obviously be TCS, but I think Infosys also, to my sense, should be guiding for good, healthy margins for the next quarters and beyond. HCL, of course, both TCS and HCL, because of the earnings growth visibility they have, they obviously are one of the top picks.
The other dominant factor, like we highlighted at the start of the show, has been the oil surge, all the way to that $79 per barrel mark. Now, what we're expecting at ET now from the oil and gas sector is good numbers from the upstream companies. The petchem business, for cases in point being Reliance Industries, is looking to offset the refining margins. Inventory gains are going to continue to boost OMCs, and we've seen the kind of underperformance that's played out in OMCs in the last 6 months or so, and then of course the bouts of traction building for OMCs in the last fortnight or so. Gautam, do you believe oil surge is going to help the upstream companies in particular, and that's the segment that we should stick by as an investment proposition too?
Actually, this quarter is going to be very good for the oil and gas company for the reasons that you just mentioned. The problem has been with the stock prices. If you remember a year back when crude was at 40, I think ONGC was around 200. And today with crude at 75, 80, ONGC is still not at the same level. So while the fundamentals have been very different, the actual stock performance has been very divergent. Our preference in that entire space remains with gas plays like Petronet, IGL. We continue to like OMCs now after such a drastic correction, and it's a good place for someone who has a contra leanings. While one can never predict how the government policy will evolve in an election year as far as crude, as far as this entire fuel pricing is concerned, but I think fundamentally, if you see the valuations and what all the current stock prices are factoring in for OMC, I think it's a good bait from this levels. For the quarter, we are expecting roughly 44-45% growth for our universe in profit, but it is coming on an extremely depressed base. In the base quarter, there was a decline of 26% for our universe. So, I mean, that theme continues, where metals and oil and gas, being the cyclicals, continue to lead the earnings right from the front. It's been happening for the last 2-3 quarters, and this quarter should not be different either. We're expecting 60% of incremental profits to come from this two sectors this quarter.
Okay, fair point. Ravi, Gautam, both of you stay with us. We're going to take a very quick break, but when we come back, it'll be focused autos, metals, FMCG, and a whole host of other sectors. What should you expect this earnings? We'll discuss with our panelists when we come back.
Your dizzying lifestyle needs investment ideas at lightning speeds. Watch Market Fatafat. Get 30 big stock ideas in just 30 minutes. Market Fatafat. Quick, crisp, credible. Market Fatafat. Only on ET Now. Rise with India.
India is growing. Are you? Have you secured your financial future? Does your money work as hard as you do? Presenting The Money Show, India's only daily show on money and personal economy, where we answer all your financial and investment queries and resolve to help you rise with India. Weekdays at 5:30 p.m. only on ET Now.
recognizes the size of India, the fact that we have a sound economy, the fact that we have the fastest growing economy.
Is the biggest jumla I've seen.
We've taken action ahead of any other regulator. So it tells you how vigilant we are in this matter.
If it's a slugfest between two political parties or more, then truth will become a casualty.
The nation's most pressing issues need solutions.
Back with earnings preview right here on ET Now. Come tomorrow, you'll have Innocent Bank as well as TCS deliver its numbers, and we're going to officially be kick-starting earnings season. So let's take it across to Pankaj Podar, my colleague, and try and get a sense of what some of the top brokerages are penciling in for this quarter's performance. Pankaj?
Well, if you just look at what markets are predicting in, I've got Deutsche Bank as well as JP Morgan with me in terms of previews. But let's look at the backdrop. So INR has fallen about 5% and it's at an all-time low. You have crude, which is up close to about 15% from the last time and close to $70 a barrel. So that's the sort of number that you're seeing on crude. And of course, 10-year bond yields have also gone up by 50 basis points to 7.9%. All this, of course, definitely has an impact on the earnings. And this is the backdrop that one should consider before they look at the earnings preview. Now, this is Deutsche Bank. So 20% plus growth in sales, 20% plus growth in the PAT number. Very, very strong expectation. But remember, last time around, there was a one-off impact of GST, and that's why the numbers are looking the way they are. But within this, some of the stocks that they like, some of the stocks that they believe will do well, M&M, Maruti, Bajaj Auto, Dr. Reddy, Sun Pharma, BPCL, ONGC, these are the stocks that they are saying that they would advise their clients to watch out for. They could declare some very, very strong set of numbers. So these are the stocks, according to Deutsche Bank, to watch out for. Let's also look at what JP Morgan is saying. They're saying a 20% growth on a YOY basis is what they are expecting in terms of PAT number. So that's the number that they are looking at. Aggregate sales and EBITDA growth of close to 25%. Now, if you come down and look at what to expect in terms of numbers, now the PSU Bank will have an impact as far as the PAT growth is concerned, because there will be higher provisioning, when you look at the PSU banking space. And that's the reason, why they essentially believe that the PAT growth might be slightly lower than what the sales and EBITDA has been, essentially has been doing. If we just go ahead and look what they like, what they don't. So they believe that private sector banks will do well. PSUs particularly will have to write off quite a bit, and consumption as a pack may continue to declare good numbers. This is essentially what JP Morgan is saying.
Okay, Pankaj, we'll leave it at that. And thanks really for providing an overview of what to expect. We're talking sectors with our experts. So let's take it across to Karanya and Mubina as well from our research desk. Karanya, you go first. Autos, and given the kind of stock performance and the story each and every auto major is, what is it that we can expect from the earnings?
Well, looks like it's going to be a stellar quarter for the auto industry as well as the auto ancillary space as well. A couple of factors which are responsible for this healthy growth. Of course, first up is the fact that there's been a very strong rural uptake which has boosted the volumes immensely. Apart from that, the government has also, undertaken a couple of initiatives to boost rural infrastructure, to improve the connectivity overall, which has also lended support. And of course, this backed up with a good lineup of new launches and of course the low base effect of last year. All of these factors come into play, which could actually lead to a good quarterly performance this time around. What the industry is expecting is a double-digit growth for most of the OEM players. Margins, despite the commodity inflation, despite the price hike on the RM front, margins could actually improve, especially on a sequential basis, owing to price hikes and operating leverage benefits. If you look at some top outperformers, the street is betting big on Ashok Leyland, Bajaj Autos, Eicher Motors, as well as Maruti. Like always, that could be an outperformer. And among the underperformers, well, Tata Motors is one company which could see some amount of pressure. Of course, there's been that fact that there's been a low scale in JLR volumes that could weigh in on the margin performance. And of course, on a standalone basis, also the commodity inflation is something that could put a bit of pressure on the company's performance.
Yeah, indeed. Mubina, quickly tell us what to expect from FMCG and metals, the sectors you cover.
It's been quite a quarter for the metal space, but I'm going to first talk about ferrous companies because we have seen steel spreads rise significantly. So that will have an impact on steel companies. But there is also that pinch of higher costs, which may be felt by some of them. But Tata Steel is expected to emerge strong, and we are also expecting Coal India to do well. Non-ferrous metals, meantime, have seen quite an exciting quarter with aluminium prices rising. So I'd also want to watch out for Hindalco and Vedanta. But for FMCG, remember, the base was low on account of the GST implementation. So in all likelihood, it's expected to once again be a good top line as well as volume growth for FMCG companies.
Gautam, if I could come to you on autos particularly, there is no denying that it's been one of the most robust stories, a clear indication of the consumption trend, which has been really strong in the country. And we can say that in the volumes picture month after month. But the valuations for the top few have been rather bloated. Is it time now to get bottom up? Maybe bet big on Tata Motors or more the internal consumption-led domestic stories like a Bajaj Auto?
So I agree on Bajaj Auto and not on Tata Motors. The point you mentioned on consumption is something I completely agree with. It's been there since last 1 year. We've been highlighting CY18 as a consumption recovery year, and it's panning out quite well so far. In fact, last quarter's commentary from different corporates, whether it is in auto, FMCG or other B2C oriented sectors, did suggest that rural consumption is finally on the uptick. And it seems that in an election year, the government will be indulgent towards rural consumption. We have seen the MSP hikes last week. Monsoon hopefully should continue to progress well. So the drivers for rural consumption are in place. As far as stocks are concerned, I think the quality will remain overpriced in this market because you're not seeing a very strong pickup in earnings growth from the rest of the sectors. So what is delivering earnings growth will continue to get overpriced, be it private financials, autos or consumer discretionary, and to an extent even IT now. So we like auto, it's one of our preferred sectors. For the quarter, obviously it's going to be a party out there led by low base. For our universe, there was a decline of 13-14% in profit in the base quarter. So this quarter we are expecting 33-34% growth. The right way to look at some of the sectors which had a very low GST driven base is to look at 2-year CAGR between June 16 and June 18. So you get a normalized earnings then, same for consumer. So on auto we are expecting 35% growth for Eicher, 50% growth for Maruti, almost 60% growth for M&M. Bajaj Auto, which is a stock which we incrementally like more and more, there we are forecasting almost 32% growth. Ashok Leyland earnings will more than triple almost. So across the board, barring Tata Motors and to an extent Hero Honda, auto pack will have a very strong quarter. And obviously you've seen that through in the monthly auto numbers for the quarter.
Ravi, would the same rationale apply to FMCG too? Valuation's expensive, but that's where the growth is. That's where the consumption patterns are strongest. But rural demand, of course, also now seems to be favoring them and on their side.
FMCG growth, at least for Q1 FY19, is primarily because of the low base. Last year, demonetization and GST actually brought down the base because of destocking. So the growth is definitely going to be visible in that space. The other thing which is also happening is that the margins are expanding for them. And on top of all of that, again, like I said before, the same thing what happens to rural autos and rural, my sense it will also happen to FMCG moving forward. And we have seen that. You see, in some of these rural pockets, going to these small kirana shops in some of these rural towns and villages, earlier if it was one sachet of shampoo being purchased, now the same person purchases about 3-4 in a week. So to that extent, I think that there's a huge demand for FMCG. More than that, if you see, the non-farm income for rural is significantly going up because of the opportunities outside the farmlands, in terms of moving to close by towns and maybe close by factories to earn a living. The opportunity labor cost is very, very high these days. So obviously consumption has to do well.
Gautam, what about metals? While the cycle seems to be intact and favoring them, but year to date we've seen the stock prices underperform other sectors and the benchmarks perhaps. You think high spreads are going to aid the ferrous companies and non-ferrous metals may feel the pinch of higher costs?
So on metals, I've been negative for last 6 months now. While the numbers continue to look good, I think that the stock prices, especially in deep cyclical sectors like this, one has to be very early in entry and exit. I think last 2 years has been phenomenal for metal. FY19 will be the last year where earnings growth will be very strong, at least on this cycle. Obviously in cyclicals you cannot talk too far ahead, But I think this quarter particularly, where we're expecting 75% growth for our universe on a very high base. Remember, in the base also metals profits had doubled. So while the profit performance and earnings EBITDA performance continue to remain very solid, one has to take a very cautious approach on the stocks, because the current profits will not last forever. This is not a secular sector. And secondly, a lot of these companies are bidding for assets in NCLT which will possibly over leverage their balance sheet, and therefore there could be a transfer of EV value in favor of debt away from equity, which is exactly reverse to what happened in the last 12-18 months. So therefore, while the performance will remain strong for 1 or 2 more quarters, stock prices may not reflect that.
Fair point. Ravi, as we wind down, where do you think the outliers, the dark horses, could emerge from in this quarterly earnings performance?
The thing is, if you look at sector by sector, aviation could be seeing a huge downfall. I don't know whether people have factored in that, for the simple reason that the aviation fuel cost is going up, yields are coming down. Corporates who have been able to pass it on will do well. Corporates which are not able to pass on the increase in fuel costs will suffer. My sense is SpiceJet will do well. We think dairy will do well, because the sales growth is going to be about 5% in our estimate. But since the procurement cost of milk has gone on dramatically, we expect a huge increase in EBITDA margins for some of the dairy players. Rest of it, all the mainstream sectors like your FMCG or your consumer discretionary, metals, banks, I don't think there's anything great surprise in store for us.
Okay, Ravi, Gautam, both of you, thank you so much for taking the time out and staying back in office in these torrential rains as well, and try and discuss and analyze what could be the performers and underperformers this earnings season. Promises to be an exciting one. Let's hope the numbers as well and the performance and delivery is as exciting too.